Hello, everyone. Welcome to our K-1 and Pass-Through Entity series. I am Dave Stauffacher, the Senior Credit Training Officer with Lenders Online Training, and that's where we help lending and credit professionals say yes to good loans and maybe no to loans that are not quite so good at the time. So Linda Keith, our company's founder and chief credit trainer, is joining me again today. Thank you for joining, Linda. How are you?
I'm doing well. Thanks for having me.
Awesome. Once again, we have another great question from our viewers. This one has to do with the K-1 has to do, I think it is with distributions. Not sure. It says, how should I treat cash differently from property on the K-1? Now, I know in some of our other live streams, we talked a little bit about this generally. So let's maybe take a little bit of a deep dive into the question at hand here. I think it's distributions. Linda?
I agree with you, and you're right. In another live stream, we have talked about the formula for actual cash flow from either a K-1 on a 1120S or 1065. So let's just key right in on the distributions, and if they're cash or if they're property, how do I tell, and why do I care, or do I care? Well, first answer is check your guidelines. Check your guidelines. My guess is your guidelines say if it's a 1065, use line 19, code of A, that's cash distributions. If it's a 1120S, use line 16, code of, I think the D there, code of D, that's distributions. And I'm betting, go check. I'm guessing that's what your guidelines say, which would mean that for a 1065, we are using only cash. Because on a 1065, they have one line for cash, that's code of A, but then code of C would be property. So if you're using code of A, you're only using cash, but on the 1120S, sorry to say, they have cash and property on the same line. That line 16, items affecting shareholder space, is code of A, cash and property combined. So first, let's talk about which you should use. Then let's talk about, can you even tell? If you can tell that it's property and cash combined, so you look at, let's stick with the 1065 for a moment. You see the cash, but then you recognize, wait a minute, here's some property also, code of C, I guess it is. Well, is the property and cash combined comparable to the cash only in the other years? Here's what I'm going for. Let's say you get a partner in a partnership. They get $30,000 pretty much most years for their distributions. This particular year, one of the partners says, you know what? We aren't using that truck anymore, and I could use a truck. Why don't I just take part of my distributions and just take the truck instead? If they could have been paid cash, if the liquidity was there, if it was their typical number, I can't imagine why I would say, oh, no, never take the truck, because then we won't count it. So the key is that they had plenty of liquidity. They typically do provide cash distributions for that combo. And that particular year, there was property. Unlike if they usually get 30,000 cash, they got 30,000 cash that year and an additional 50,000 property. I would be with you. Maybe we don't count the property that time. So I think you need to understand what's typical for them. Do they have plenty of liquidity? Could they have made that cash contribution? Turns out we'll need the full entity return to spot that, because we're now starting to look at your favorite, David. That's the balance sheet, right? Yes. Liquidity, all that kind of stuff. So if the property was distributed in lieu of cash because the owner preferred property, and the entity was no longer using it, I'm inclined to use it if it was comparable to cash. We won't know that in the S Corp. And so we're going to come right to this next step, David. Would you please help us with where we'd find it?
Okay. You mentioned a little bit about before, as far as where do we find this on the K-1? If we deal with the 1065, cash distributions are going to be on line 19, but we have to focus on that code. And if you look at the back of the K-1s, there's all kinds of codes there. I think, how many was there at one time, Linda? We had talked that
100, I think.
100 codes. And I'm looking for one or two. That's all I'm looking for. So what we would look for is cash distribution would be code A. That's on line 19. And then if it's property distributions, that's going to be code C. So that gives us an idea as far as their difference. You don't necessarily have that with regards to the 1120S, as we mentioned before. They're all kind of together in that we have to be careful on that we understand that. I think that covered most as far as where they're located. Linda, any other things you wanted to mention?
Yeah. You will never know on 1120S which you've got. You just won't. So here is a question. I've brought this up in other live streams where we have the same issue. Sometimes we know something about one borrower because of the tax return they're filing that we don't know about another borrower who may be in a very comparable situation, but the tax return they're filing is simply different. The IRS is not caring about us. They're not trying to be consistent. They're not trying to give us information helpful to us. And therefore, things can be in different places and mean different things all over the place. So here's the question. When you notice that there is a difference, so if you're aware now, maybe you are somebody who is responsible for guidelines, you go, geez, now that I think about it, we just say 1065, line 19, code of A, and we never even talk about that there might be property in addition to cash and that somehow we would want to consider that. But with an S Corp, we always let them use cash and property. The question is, do our lenders even notice this, are even aware? For example, let's say your cash distributions was way different. Here it's 50,000, here it's only 20, here it's 50 again. Do we even tell them, by the way, that 20? Take a look and see if there's a code of C of $30,000. Maybe they're all 50,000. We just have some property in one of those years. So consider whether the difference between cash only with a 1065, cash and property with 1120S will ever make a difference for your loan decision. It may be so infrequent. It may be somewhat immaterial. You may not be concerned about it. It is absolutely true that David and I don't think that you should know everything that we know about tax returns, right? We work pretty hard to decide what's relevant, what's material, what will make a difference in a loan decision that is an important difference. But whenever you run into these situations where you realize, geez, I'm treating one borrower different than another just because of the tax return they file, just consider, should that be a concern? Should we change what we say? I probably wouldn't go out and change all of our worksheets to say, like code A and C. I don't think I'd do that for 1065. But if they're seeing a difference, I'd like them to realize, oh, that could be where this difference is. All right. So it's not so much treating people fairly if they're an S Corp shareholder than partnership, owner. It really is more what's relevant, what's material, what will inform a good loan decision. And that is how I would answer the question, do I treat cash differently from cash distributions, differently from property distributions on a K-1? First of all, it depends even if you do see all of it, but also how often is it material? David, what do you think? We got that one?
I think we got it. It's an interesting one when we're talking about when you're dealing both with property, because I don't know how often that happens. In my years when I was in banking, it didn't happen that often. So I was really focused on the cash. So I'd be curious on how that translates into when you're developing your guidelines, when your lenders come and talk to your senior levels to say, how would you want us to treat that? I think that would be a fair conversation when you're developing guidelines to say, this is how we treat it and we look for consistency.
Well, and it would be very unfortunate if we end up declining a good loan because we missed this.
Yep.
We want to say yes to good loans. We want to say no to ones that won't be performing per our risk guidelines and the whole bit, but we really don't want to decline a performing loan that actually would meet our guidelines if we had spotted this situation that should not have caused us to walk away from that loan. That's it for today. We would love to hear questions from you, experts at lendersonlinetraining.com, or feedback, whatever you want to tell us. Send it to that. We'll get it. Also, If you have, so this is the way to ask your question. We will answer it. It may become a live stream. It may become one of our blog posts. In addition to that, if you are ready to talk to us about improving your knowledge at a foundational level on tax return analysis, or that of your team or your junior folks, lendersonlinetraining.com/talk. It is simply a conversation about what you need, what we do, and seeing if there is a fit there. And if you want to sign up for Ask the Experts, that's actually a weekly email. Also comes from the questions that you ask and that people in our classes ask, because David, you do those classes. They ask a lot of questions, right?
Yes,
So,
wonderful questions.
We get lots of questions. And some of them are repetitive, and every once in a while we get one, we go, whoa, nobody's asked that before. Let's think about this. But lendersonlinetraining.com/ask the experts weekly email. Subject line says what the question is. Ignore it, pass it to your team, read it. And of course, you could unsubscribe from that anytime you want. We are happy to be here to help you make better loan decisions. Avoid the ones that you want to say no or should say no to, and make sure that you can make the loans that should be a yes in a way that you can sustain it, document it, do it again, keep those clients coming back because you actually understand what they're doing. That's it for today. Thanks, David, for coming. Thanks to you for joining us. We'll see you again next week.
Bye.